Hello, everyone, and welcome to Market Outlook 2017. My name is Adam Koch, and I'm President and Portfolio Manager at Libertas Wealth Management Group in Columbus, Ohio. And Happy New Year. Hope you enjoyed your holidays, had a long, relaxing break, and that you're excited for 2017. I know I am. So let's go over our agenda briefly here today. First, we're going to talk a little bit about this past couple years, which was a very interesting 2-year period. And next, we're going to talk about what we might expect from the markets going forward. And then we're going to end a little bit differently this year with a little bit of humor. So let's dive right into it and optimize our screens first and foremost. So a little bit of housekeeping here. What you want to do is you want to click on the gear at the bottom right-hand corner of your screen, which is going to pull up this dialog box. Then you want to click on the drop down next to quality, and you want to make sure that you have your resolution set to the highest resolution possible. Then from there, you can choose between enlarging your screen right here, or in the far right bottom corner, you can click on this box here, and that'll actually make your screen full screen, which will be a whole lot easier to see everything and all the charts that I'm about to show you here. So let's just go ahead and get started. I'm going to do things a little bit backwards this year. Normally I start with stocks, but this year I'm going to start with bonds and interest rates instead. And we're just going to start with this past 12 months. The first chart that I'm going to show you here is the difference, or in other words, a chart that shows both stocks and bonds on one chart. The blue is stocks, and the red is bonds. And what you'll probably notice right off the bat is that this big, huge drop that we saw, obviously, it actually started in November before you can even see it on this chart here. The stock market going down and then bottoming in February. Now, in hindsight, of course, it came back, and we had Brexit, and it came back, and then we saw a short-term downtrend until the election, and then the market sprang right back up again. But what's really interesting to me about this chart in particular is the fact that bonds, which again are in red here, with some exceptions, you could see bonds go up when stocks went down here at the beginning of the year. You could see bonds go up when stocks went down during Brexit. But that was pretty much the end of the correlation once we saw this election day hit. So things went down together, and then election day hit, and all of a sudden we see this huge drop in bonds compared to a big rise in stocks, pretty much a sprint northward in stocks. In fact, when we look at the AGG, which is the Barclays Aggregate Bond Index, what we actually saw was a drop from top to bottom of about 5.38% in less than 6 months, from July through just about, call it just before the end of the year, before we started seeing this thing kind of mean revert. But this is a basket of all kinds of different types of bonds. What I wanted to also show you was treasury bonds, in other words, government bonds. So same kind of story here when you see stocks going down, going up, going down, up, down, and then up again at the end of the year. We see bonds here going up when stocks went down. We see treasury bonds again going up when stocks went down during Brexit. And then again, we see that correlation as the stock market went down again during the third quarter, right up until again, just before election day, where we saw that continued drop, in this case, in treasury bonds. And from top to bottom here, this is crazy, but treasury bonds, 30-year treasury bonds, and this is what I used here is the Vanguard long-term treasury ETF, which is the symbol is VGLT, Victor Golf, Larry Thomas. And this is a drop of 17.75% in less than 6 months for treasury bonds, government bonds, which is kind of unheard of. So again, situation here that we need to pay very close attention to going forward. From a bigger picture standpoint, I wanted to kind of show you what we discussed a little bit back in the third quarter, the end of the third quarter, in our quarterly scouting report, which is long-term bond prices and, of course, long-term interest rates. So what we're looking at first here are bond prices. And you can see bonds have been going up since the 80s. I mean, you can see 1981 here, bonds bottoming, and for the most part, this is a trend channel. Bonds have just been going up and down and up and down and up and down and bouncing back and forth until most recently, if we go back to this chart here, you can see that top. That's this top right here. Now, where we're at right now is probably 2/3 down the way of the trend channel here, but the question we're having in our office, and the question a lot of the industry is asking is, are we finally now at the point where bonds are going to start going down long-term as opposed to up long-term? Because back in the beginning, back here, interest rates were very high. Mortgages were in the teens, CD rates were in the teens, inflation was going crazy, and the reason bonds have been going up for so long is because interest rates have been going down for so long. So again, here's the interest rates back here when mortgages, CDs, inflation were super, super high. I'm sure most of you remember mortgages between 14 and 16% back in the 80s. But anyway, when interest rates go down, bond values go up. And when interest rates go up, bond values go down. So said another way, bond prices, bond values, and interest rates are inversely proportionate. When one goes up, the other goes down. So again, the question we have here, interest rates going up, down, up, down, up, down in this trend channel all the way down the hill for 30 plus years. The question is, are we at a turning point? Is this the point where we're going to break north of this trend channel and see bonds start to go up long term? Interest rates start to go up long term. And then if we go back to the previous slide, start to see bonds go down long term. Or are we going to see rates go down again? And are rates going to go negative like they have in many countries around the world? So we have to be very careful with what bonds we own. Historically speaking, people who are conservative with their investments, especially those who are close to retirement or already retired, have been taught that bonds are safe investments. And I guess my point of showing you this is to let you know that you have to be very, very careful with what you own when it comes to bonds. You have to be highly selective. I'd be very careful with things like high yield bonds, which called another name for junk bonds. And junk bonds have a tendency to go down when the stock market goes down. So just because you have high yield bonds in your portfolio doesn't mean you own really, really safe bonds that have a very high yield. In fact, it's very counterintuitive. It's quite the opposite. So be very, very careful and don't be fooled when it comes to the bond market. So let's change gears and move on to stocks and talk about the stock market. One of the most popular charts that were going around earlier this year, back in February after the market really went down, was this one right here. So this is February that I'm circling with my mouse here. And this was a chart where somebody was saying basically here where we are is where we are right now, 2015 to present. And this line right here was the 2008-2009 stock market crash where the market went down 57% from top to bottom. So a pretty convincing chart when you look at how things were from 2015, down, up, down, and then here we are in February. It was pretty easy to see, especially with all the other things that were going on, that we could have seen a pretty substantial crash this past year or even within the past 2 years. Again, with hindsight at our disposal, playing Monday morning quarterback, that's not what happened. But the last 2 years look like this. So what we're looking at here is the S&P 500, so the stock market, over the course of the last 2 years approximately. And this box right here is what we call a trading range, or in other words, a big base, which just basically means that the market's going nowhere. And whenever we're in a trading range or a base like the one you see in this box right here, the risk of a large decline is very high. And we need to be much more conservative in times like these versus times when we're seeing consistent higher highs, higher lows, and in other words, positive trends. Instead, what we saw this last 2 years, right up until the election anyway, which is right here, is a sideways trendless market with generally a downward bias. And what I mean by downward bias was even though it was going sideways, things looked like they were starting to topple over here about halfway through the box, as you can see. So, we had two corrections. If you remember, late summer, market went down 12.4%. Then peaked again in November, went down 14.8% until February of this year, and then things started to go back up. Then we had Brexit, which is right here. Then the market came back in summer, kind of putzed along, short-term downtrend right here. But the good news is, the longer the base or the trading range, so the wider this base is, the bigger the breakout or breakdown. And in this case, we broke out to the upside, not down to the downside. So this could mean really good things for the stock market going forward after 2 years of pretty much nothing and nowhereness, if that's a word. Next, what I wanted to show you was for the longest time, the news, all they could talk about was when the market was going to surpass the May 2015 high. Because the market went up here, 2015, it peaked in May, and then it pretty much started going crazy. And again, market goes down over 12%, goes down over 14% only 6 months later. And then we have Brexit, and finally it breaks north of this position. And then it's a head fake, and Brexit occurs, and the market goes back down again. But what's interesting is that the market's only up 5% since that May 2015 high. So it's only up about 5% in the last, call it, year and a half or so, which is interesting. But what I found even more interesting was this. As I was playing around with the charts and putting things together for this presentation, and I drew a line from May of 2015 all the way across, what was interesting was the closing price of the S&P 500 on May 2015 was almost the same as the closing price the day before Election Day. So in other words, the market's only up about 5%, 5.03%, so a little bit less since Election Day. So again, the good news here is the wider this base, the bigger the breakout or breakdown. And again, what we're seeing here is not a breakdown, but instead a breakout to the upside. So like any stock market, we're going to have pullbacks. We're going to have times where the market takes a breather like it is right now. But right now, the way I see the market is any pullback should be seen as buying opportunities, not the other way around. All right, so let's move forward and talk about what might happen with the market going forward from here. So here's another chart that has been going around recently. And what they're comparing here is the stock market that we've been through, this kind of sideways nowhereness, again, over the course of 3 years, to 1995, once it broke out from that same, I shouldn't say same, but similar sideways movement. So in 1995, when things broke out, I'm sure many of you remember the late 90s and the ridiculous bull market that occurred from there and how great things were. What I think we need to keep in mind, though, is that while this chart looks really great and that a breakout north kind of makes sense, because again, as the saying goes, one of my friends, J.C. Peretz, says, the bigger the base, the higher in space. So while that looks like what we're going through right here, at the same time, remember this one we looked at a few minutes ago? It looked reasonable at the time as well. So the main point I want you to recognize here is that both these charts, this one, which ended up being wrong, and this one, which is a new projection or comparing to 1995 to what we've just gone through, could both be wrong, right? So I think that it's important not to be too predictive, I guess, and just instead of being predictive, to kind of look at where we are today and to adjust our portfolios accordingly. This is a long-term chart. If you've worked with us for any period of time at our office, you've seen this chart in our office. Basically, what we're looking at here is a 24-month period from top to bottom where the market peaked, the dot-com boom. So the market peaked in 2000 and went down for 24 months, went down 47%. So that was the first big crash, the dot-com bubble. Then market bottoms, 2002, starts going back up again. And over the course of that 5-year period, market goes up about 120% or so. It peaks right here in 2007, and then in 18 months, the market wipes out all 120% of the gains that occurred in the 5 years prior, and another 15% on top of that. And again, in only 18 months. What we're living in right now is the second longest bull market in history, and this is this flat 2-year period of nowhere that we've been talking about, and this is why it's been so important to be as conservative as possible. And with all that said, it's always possible that this turns into the longest bull market in history, and that maybe this turns into the next 90s. So what's most important when we're looking at this chart is to understand that anytime we get longer in the tooth, in other words, when the market keeps going up and up and up, we are 1 day, 1 week, 1 month closer to it being the top. And of course, we never know when the top has hit until it's already behind us. So moving on here, the next thing I wanted to talk about is what the market typically looks like in post-election years, depending on who wins the presidency. And the first thing in the legend you'll notice is all post-election years. So since 1953, the average return for the stock market in all post-election years, which is what we're in here in 2017, is about 5%. So that's the average return of the stock market, in this case the Dow, since 1953, for all post-election years. That's in contrast to whenever a Republican wins their first term as president in post-election years. When a Republican wins, the average return's right around negative 2%. And then you can compare that to the average return right here when a Democrat wins their first term in a post-election year, which is just above 8%. So when you look at this chart at first glance, the first thing you'd notice is, okay, so post-election years are typically good, but a Republican won this year, obviously, and that typically doesn't bode well for the market right here at negative 2%. As opposed to a Democrat who, if a Democrat would have won, maybe we would have expected 8% on the positive side, which obviously would have been good news. But when you dig deeper into the numbers, and you compare this chart to the last one, which only takes into account who the new president is, when you add in who controls Congress, and you have a Republican president and a Republican-controlled Congress, the average return for the stock market is actually around 14% per year, which just happens to be the second best combination when you look at the president and who controls Congress. So in closing, I wanted to do things a little bit different this year and end on some funny slides that I came across throughout 2016. And some of these are going to be funnier to some than others because they're kind of nerdy. But the first one here is a chart that I found back in September. This guy on StockTwits, he tends to post some really, really funny charts, and he called this the flying mallard pattern. Now, I don't know what this is supposed to mean, but Donna, my wife, was sitting next to me on the couch when I saw this chart the first time, and I literally could not stop laughing for about 5 minutes. I just thought this was hilarious. Not quite as funny, but still funny. This next one is the America First pattern. Again, I don't know what this really means, but it's just supposed to be for fun, obviously. And speaking of fun, this is the Trump hair pattern. Kind of a funny chart there. This one's kind of a higher level joke, but I'm just going to keep it short and not even explain it. If you don't understand it, email me personally, give me a call, and I'm happy to share what this one means with you. And then last but not least, we have Michael Jordan here, which poor Michael, people use his picture, the picture of him crying quite a bit for lots of different posts, but this is the Dow almost 20,000 hat on Michael Jordan crying because the Dow didn't quite hit that level that the media just kept talking about over and over and over again here through the last month and a half or so through the end of the year. Okay, so that's it today. I thank you for watching, and if you have any questions at all, if you'd like to receive an intro kit sent to you via email or snail mail, or if you'd like to talk to our office about setting up an introductory meeting with one of our financial advisors, please call or email us anytime. And remember, you don't have to be a client to ask a question, so even if you just have questions, feel free to fire away and we'll get back to you at our earliest opportunity. And in closing, I hope that you all had a happy new year, and we'll look forward to talking to you soon.